Holy flippity flip the flapping smokes, everyone. It's time to panic because banks are telling us not to panic. In today's video, we're going to go over the latest warning by banks telling us to don't worry, even though defaults are going up, even though bankruptcies are rising, even though we're facing recession, even though people using credit cards just to be able to afford groceries, they're telling us, don't worry, please don't panic. Well, there's an old saying that says, if you're going to panic, it's better to panic first, especially in the case of a bank run, because if you panic last, guess what? Your money's not going to be there because the banks only have about 10% of deposits in cash. So this is what we're going to cover in today's video. We also got some more news what's happening with mortgages and more news what's happening with central banks and warnings from other banks about how the stock market crash isn't over and how it could get much worse. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, well look at this everyone. No reason to panic. Commerce Bank CEO says lenders are better prepared to deal with loan defaults. Well, of course, a banking CEO will tell you not to panic. That's literally their job. The bank could be on verge of collapse like Lehman Brothers was in 2008, and they'll keep telling you, don't worry, everything's fine. Probably the German economy is going into a downward trajectory and maybe into a recession, but the good news is there's no reason to panic. People, I don't know about you, but this to me sounds like desperation. We all know that Germany, with their current energy crisis and gas crisis, is going to be heading into a deep, deep recession. And guess what? If people can't afford to buy food, if people can't afford to pay their energy bills, that's not a recession, that's a depression. I don't care what the statistics are. If people can't afford the basic human needs, we are in a depression. But they'll never admit that because they don't want to lower consumer confidence. Asked whether he expected non-performing loans to rise substantially over the course of the winter, he said, if a recession will be there, then it is likely we'll see something, but the situation is significantly better than in the past. So to put it simply there, he's saying, if we enter a recession, yes, we will, which they are going to enter a recession. And he tries to say, well, look, don't worry, it's better than in the past. I think it's actually the opposite. It is much worse than in the past because debt levels around the world from these 0% interest rates or negative interest rates like they have in Europe have made people get addicted to debt. They've taken on so much debt. And what I'm going to show you later in the video, the European Central Bank is now starting to hike rates aggressively. And I know most of my viewers are in Australia and in the US, so you're probably wondering, well, how does it affect me? People, the whole global economy is very interconnected. Like how we saw with Lehman Brothers collapse, it triggered a global financial crisis. Well, if we have a European banking crisis and a recession or depression in Europe, it is going to have big flow-on effects in the rest of the world. Banks have done their homework. We are all capable. We have enough buffer to help our customers during this crisis, and this is really what counts. Therefore, we are concerned, but we are not worried, and again, there's no reason to panic. He keeps on saying it again and again and again. Don't panic, don't panic, don't panic. I don't know about you, but when someone keeps telling me not to panic, it just makes me more and more anxious and suspicious. But with what was announced yesterday, we are going to see non-performing loans, aka more defaults come and more bankruptcies come. Look what the European Central Bank is doing now. The ECB goes big with jumbo hike as Lagarde hints more to come. Deposit rates rose to 0.75% from 0%. Economists saw a 0.75% increase, and new forecasts show faster inflation and flagging European economy. So this is absolutely insane what the European Central Bank has done. They have let inflation run rampant and they've been sitting on the sidelines. They had interest rates in the negative and now they're still not even at 1% interest rates when inflation is around 7, 8, 9%. And we all know it's really much higher than that. And what we're seeing with power bills in Europe, we're seeing power bills double every 6 months. So they're going to have to get much, much more aggressive than this. And really, I think the European markets are absolutely screwed because they're not going to be able to lift interest rates high enough to fight inflation. But if they don't, well, they're going to go the way of Turkey. Look what's happening with Turkey now. Turkey inflation has hit a new 24-year high beyond 80%. And that's the official inflation figure. I'm sure it is at least double that, especially what a lot of locals in Turkey are saying and seeing on the ground as well. And if you thought central banks were going to slow down, no, they're going to keep their foot on the gas for much longer. So people thought inflation peaked, but Fed Chairman Powell vows to raise rates to fight inflation until the job is done. That's why we have seen a short dip in the inflation headline number. we are still seeing prices rise pretty aggressively. And what's been a big contributor to prices falling is oil falling. The reason why oil has been falling is because the US has been draining their strategic emergency reserves. And once that is drained, which should be at the end of October, right before the midterms, well, then I expect oil will start to go higher again. And then we'll start to see inflation pick up again towards the end of the year. And the Federal Reserve may just have to keep on hiking. And once interest rates or the federal funds rate gets above 4%, that's when we're going to see things get really ugly. That's where we're going to see the economy, maybe they'll finally admit that we're in a recession. That's when you're going to see defaults rise. That's when you're going to see bankruptcies rise. That's when you're going to see companies' earnings collapse. And you're going to see the stock market crash much lower. Look what Deutsche Bank is now warning about. So Deutsche Bank strategists see 25% stock slump if recession hits. Earnings outlook, high valuations threatens sustained rally. So I completely agree here. I think it is inevitable we're going to be in a recession, but the banks and the government don't want to admit it. But when the inevitable does happen, when the companies finally get the message, when consumers finally get the message that we are in a recession and they stop spending, because remember, in the US, Australia, it is a consumer economy. We don't produce much goods, we just consume goods, and that makes up anywhere between 50 and 70% of GDP. So once people stop spending from higher interest costs, once the debt burden becomes too unbearable, once prices get too unbearable, we will enter recession and stock prices are going to have to correct, because even though they have corrected, we are still at historic high valuations. And Goldman Sachs, Morgan Stanley also said stocks may fall to new lows. And Michael Burry has come back out on Twitter again to reiterate that no, we have not hit a bottom. He tweeted here, no, we have not hit a bottom yet. Watch for failures, then look for the bottom. And I completely agree. We're going to start to see some companies fail once we do enter recession, once interest rates get higher. And once, it really looks like the world's going to end, once the market falls at least 35%, then that may be the opportunity to start buying the real mega dip. He says 2 SPAC ETFs failing is not near enough. He also tweeted, inflation appears in spikes. When the spike is resolving, it won't be because of Biden or Powell. It will be because that is the essence, the nature of inflation. It resolves, fools people, and then comes back. Neither the President of the United States nor the Fed will take credit. And that's completely right. When inflation spikes and they compare inflation with month-over-month numbers, well, then it begins to fall. Then when inflation falls and then we get more price hikes, well, they're comparing that with lower prices from the previous month after prices have fallen, and then we see inflation spike again. Now, also something I keep hearing from people and from these banks and from these CEOs and from these talking heads on mainstream media, they keep saying, why are they lifting interest rates? They're going to crash the economy. They should just stop lifting interest rates. They should bring them back down to zero. Well, people, again, do I need to show you the headline of Turkey where their inflation is at 80%? You simply can't have your cake and eat it too. You can't drop interest rates to have this booming economy, soaring stock prices, crazy inflated real estate values, and have low inflation. If they do reverse course now, this is going to make inflation go to much, much higher levels than we saw in the 70s and 80s. So the Federal Reserve has to act. There is no option of lowering interest rates to let the economy keep riding. They literally have to do this, because once inflation gets out of control, like what we're seeing in Turkey, Iran, Argentina, etc., it is nearly impossible to stop. Now, what these high interest rates are going to lead to is a lot of pain for the housing market. We've seen mortgage rates explode, and what a lot of people are saying is, well, in the US, mortgages are fixed for 30 years, so my property value won't go down. Unfortunately, people, it doesn't work like that. Even though you've got your mortgage locked in, it could be 2.75% for 30 years. Well, if a couple of your neighbors sell their home in your street, when the bank goes to value your house, or when a realtor goes to value your house, they look at comparable sales. And if you have 2 people sell their house on your street that have a similar home as you do, and even though you haven't done anything to your home, you haven't sold your home, you don't need to sell your home, if the values of those properties sold have dropped, your home valuation is going to drop as well. And we've just hit new high for mortgage rates. Look at this. Mortgage rates hit 5.89%, the highest level since 2008. And rate on 30-year mortgages topped an earlier high in June. And this is for people with very good credit. We're seeing people, if you don't have, an 800-point credit score, we're seeing mortgage rates much higher than 6%. With the Federal Reserve likely to announce another 75 basis point hike this month in September, I think we are going to see see mortgage rates rise much higher than 6%. So everyone, even though we're seeing the markets rebound a bit right now, again, remember, this is all noise. I don't know about you, but do you think there's anything bullish happening in the economy? Do you see the economy booming? Do you see interest rates going lower anytime soon? No, they're not. So these are just dead cat bounces. These are just bear market rallies. It's just algorithms trading. There is no reason why the market should be going higher. And I expect once central bank keep lifting interest rates, once we start getting some more data to show how bad things really are, I think we're going to go much, much lower. And for all those people that have the money in the bank account, you may want to have some cash on the sidelines because the banks may find themselves in trouble as well, like what we're seeing in Germany right now. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks to all my viewers that have dropped the super thanks in the comments below. I'll see you all in the next video.